but if you go back to the 1970s, gold started the decade at $35 an ounce, and it ended at around 850. Now think about that percentage gain. That is enormous.
You mentioned pivot. Should the Fed pivot? People think, they'll pivot back to QE or something else in their so-called toolbox, but you're saying the pivot might actually be a pivot to surrender.
Yeah, no, they shouldn't pivot. They should
Okay.
continue to allow rates to rise. In fact, they're moving too slowly. Rates are still much too low. They've got rates at 2.25 to 2.5. Well, that might have been okay when inflation was 1.75, but when inflation is 9%, how do you justify interest rates of 2.25? I mean, that's, less than a third of the inflation rate. You've got negative 6% real yields. That is a highly stimulative, highly inflationary monetary policy. The Fed needs to move to tight money. Well, tight money means that interest rates are higher than the inflation rate, and we're not even close to that. So we're not going to fight an inflation fire by pouring gasoline on it, but that's what the Fed is actually doing.
Peter, before QE, the Dow Jones was at some 7,000 to 8,000 points. Should the markets correct? Does that 7,000 to 8,000 point come back into play, considering this was pre-QE, pre-heroin, pre-punch bowl? Would that number come back into play?
Well, obviously, if the Federal Reserve did the right thing, the way it did the right thing under Paul Volcker, and just got out of the bond market, started to really shrink its balance sheet, not just talk about it, but actually did it, and started to withdraw all this liquidity that it supplied into the economy erroneously. We start to really shrink the money supply and let interest rates go up. Interest rates are going to go way up, like they did in the 1980s. And when that happens, stock prices have to collapse because stock prices are a function of interest rates. The higher interest rates, the lower stocks are worth. You're discounting the future value of their income by a higher rate. Now, of course, stocks that have no income, they're even more impacted. They're going to collapse even more. All these stocks that have no earnings, that people are betting on earnings in the future, well, even if those earnings materialize in the future, they have a lot less value in the present when you have higher interest rates. And of course, when interest rates go up, corporate earnings collapse because all these corporations have debt and now they have to pay more interest to service that debt. So that kills their earnings. Meanwhile, the country is so levered up with debt, if consumers and businesses have to spend more money to pay interest on what they borrowed, they have less money to buy stuff now. I mean, so earnings are going to implode, valuations are going to get killed, so the stock market is going to completely implode if the Fed does the right thing. The same thing with the real estate market. If mortgage rates are double digit, home prices have to collapse. Nobody can afford to buy a home at the current price with double digit mortgages. So the prices have to come down to where anybody can buy, because at the margin, that's where home prices are set. It's what can somebody afford to pay for that house. And if mortgage rates are 12%, 14%, like they were in the early 80s, how low does a home have to be priced before an American can actually afford to buy one? And of course, if interest rates go up to double digits, do you think the U.S. government can afford to pay the interest on a $31 trillion national debt? Of course not. And of course, if interest rates go up that high, we'll be in a massive recession. And so the budget deficits are going to skyrocket. And so the national debt's going to be much higher than 31 trillion. How is the government going to finance it? Is it going to dramatically raise taxes on the middle class during a recession so it can pay the interest on the national debt to the Chinese or the Japanese? Of course not. So what's going to happen if the Fed allows interest rates to go way up? The government's going to have to default. It's going to have to default on treasury bonds. Can you imagine the financial crisis when the government doesn't pay its obligations? The government would actually have to default on a lot of obligations. It'd have to cut Social Security, have to cut Medicare. See, all these terrible things are going to happen if the Fed does the right thing, which is why I think there's zero chance the Fed is going to do the right thing. It's going to do the wrong thing again, because it's always done the wrong thing, except this time it's going to be the end of the line for the Fed. They can't kick this can down the road anymore. I think the next round of a QE is going to be the overdose that finally kills the dollar and sets off a sovereign debt crisis and sends gold and silver prices, to the moon.
Peter, what's the difference between what had happened in the 70s where Volcker, or ADC could raise the rates up to some 20%. And this time around, there's no way that it can be done. What's the difference? Is it just the money printing?
Well, the difference is the financial position of the United States in 1980 versus the financial position now. I mean, the national debt in 1980 was only about $1 trillion. It's 31 times that size now. The Fed's balance sheet, didn't even really have much of a balance sheet back then, as opposed to the $9 trillion balance sheet it has right now. The levels of debt throughout the economy are unprecedented compared to 1980. Back in 1980, the U.S. economy was still a creditor nation. Now we're the world's biggest debtor nation. We were still running trade surpluses in 1980, not record trade deficits. Debt to GDP, I forget what it was, maybe down like 40% or something like that. Now it's like 120%. So it's night and day. We're not in a position to do the right thing. I mean, we are, but only with far more adverse consequences than what we suffered in the early 1980s. And I just don't think there's the political will anywhere in Washington, including the Federal Reserve, to allow that to happen. Now, that doesn't mean we're going to get away with it. We're actually going to end up with something worse, because what we're going to have is runaway or hyperinflation. That is what we're likely to suffer as a result of the Fed and the government's unwillingness to let us swallow the bitter tasting medicine. So we end up dying from an inflationary disease that they refuse to allow the cure.
The stagflation of the 70s culminated with gold and silver prices at record highs. Do you think this foreshadows where prices of precious metals and other hard assets will end up this time before stagflation is defeated?
Yeah, well, if we ever defeat it. But if you go back to the 1970s, gold started the decade at $35 an ounce, and it ended at around $850. Now think about that percentage gain. That is enormous. Now, the reason that gold stopped going up in early 1980s was because of Volcker and those 20% interest rates. Well, we're nowhere close to that right now. I mean, gold is closer to 1970 than 1980 as far as where it is in the cycle. And so this is going to be an explosive rally that will rival the percentage gains, I think, of the 1970s. And that is just enormous. If you're talking about silver, I mean, silver was really about $1 an ounce in 1970. A silver dollar was worth $1. That's about an ounce of silver. And those silver dollars were trading for like $50 a piece by the peak in 1980. That was a 50-fold increase in the price of silver. What would happen to silver if you took it up 50 times here? Silver's at 20. So you're talking about $1,000 silver to have something to rival what happened in 1970. So look, there's a long way for these metals to go. And everything that's happening now is just noise as we're bouncing along the bottom.
Official inflation rate recently reported at a 40-year high of 9.1%. Yet the gold prices, they headed a bit lower. How did you see it? How do you explain that behavior, given that gold is often seen as an inflation hedge?
Yeah, well, if you also look at the bond market, you can see the answer. I mean, look at a 30-year U.S. Treasury. It's yielding 3%. Now, inflation is 9%. Why would somebody loan the U.S. government money for 30 years at 3%? Well, they must believe that 9% inflation is going to go away very quickly, and that the average rate of inflation over the next 30 years will be maybe 2%, which means there's a 1% yield. Although why anybody would take a 1% return over 30 years, that makes no sense either. But it's clear that the bond market is confident that inflation is going to go away. I think the gold market is making the same mistake. Gold traders are looking at the Fed's commitment to fighting inflation, and they believe that they've got the resolve, that they're going to do it, that they're going to get rid of inflation, and they're going to do it with high interest rates, which are going to be a headwind for gold. And if gold is an inflation hedge, and there's no inflation to hedge because the Fed is committed to get rid of it, well, that's what's keeping the price of gold down. But when investors in both markets, both the bond market and the metals markets, understand that this is all talk, it's a bluff, that the Fed is not going to be able to fight inflation because the severity of the rate hikes that would actually be required, because what they've done so far is wholly insufficient. The type of monetary policy that would actually be required to get rid of inflation is never going to happen. And of course, we're never going to get rid of inflation without the cooperation of the government. The government has to substantially cut government spending, and that's never going to happen. They're going to keep on increasing government spending. So when the markets figure out that this is all a ruse, that inflation is not going away, it's here to stay, and it's going to be much, much higher than 2%, maybe even double digits as far as the eye can see, the bond market is going to implode and the gold market is going to explode. Right? Bond prices are going to crash and gold's going to soar. But the reason that's not happening now is because investors don't get it. They just do not understand the predicament that the economy is in. They don't understand the position that the Federal Reserve is in, and they are overestimating the Fed's ability to do what they claim they're going to do. And I don't know why everything the Fed has said has been wrong. Every forecast they've made has been wrong, yet they still have credibility.